Imagine this. It's 2025 and Bitcoin has just hit a new all-time high, blasting past $100,000. Once seen as a fringe experiment, Bitcoin is now being hailed as digital gold. In fact, a recent survey found that 73% of young investors prefer Bitcoin over gold as a long-term investment, viewing it as having exponential upside. What's behind this generational shift? Today, we're going to explore why more and more people believe Bitcoin is the best store of value in 2025. We'll compare it to traditional go-to assets such as gold, real estate, stocks, tackle the big criticisms related to volatility, energy, and this so-called quantum threat, as well as use real-world examples to make it all relatable. By the end of this video, you're going to see why Bitcoin is being called the treasure of our digital age. Let's get started. So a store of value is an asset that preserves or even grows its purchasing power over time. Traditionally, people have trusted things such as gold, real estate, or stocks to safeguard their wealth. But here in the modern era, in the age and the year 2025, we've got some curveballs. These include rising inflation, record government debt, and a world more digital than ever. Governments have been printing money to tackle crises, which can weaken fiat currencies. Investors are looking for assets that governments can't inflate. And this is ultimately where Bitcoin shines. It's decentralized, meaning no central bank can dilute its value by creating more of it. For instance, in just last month, in May, concerns over US government debt and deficits hit a fever pitch. The US even saw its credit rating downgraded, and that drove many investors into non-government hard assets like gold and Bitcoin as hedges against potential dollar decline. Bitcoin's price surged, reaching approximately $112,000 in that macro storm, underlying how it's increasingly seen as a safe haven when faith in fiat falters. Essentially, Bitcoin has stepped into the spotlight as a store of value for the new era. For centuries, though, gold has been the ultimate store of value. It's scarce, tangible, and universally recognized. But Bitcoin is often called digital gold, and for good reason. Bitcoin's supply is capped at 21 million, ever. You can't mine more than that. Gold is scarce too, but new gold gets mined each year. And who knows about the potential possibility of what the max supply is? This is something in the unknown. In 2024, Bitcoin's built-in scarcity got even tighter with the scheduled halving. This is when the reward of mining for new Bitcoin was cut from 6.25 to about 6.125 Bitcoin per block. This programmed supply squeeze reinforces Bitcoin's stock-to-flow scarcity ratio to levels now beyond gold's. As the CME Group, which is, yes, it's a mainstream finance media, it even noted here, I quote, Bitcoin's designation as digital gold underscores its role as a store of value, particularly amidst the scarcity reinforced by having events. Essentially, in other words, what's going on here is Bitcoin is engineered to be even more scarce over time than gold, bolstering its value proposition in an inflationary world. So let's talk about its track record. Gold's value creeps up slowly. It's basically flat slightly most of the years. If you look at it from a long-term time frame and you zoom out on the graph. Bitcoin, though, is volatile, has been a rocket ship, though, for long-term holders. To illustrate, if you put $1 into Bitcoin around 2010, it would be worth over $6 million today. That same dollar in gold, it would be about $1.69. No, this is not a mistake. 6 million versus $1 in change. And Bitcoin has outperformed gold in recent years too. 2021 was a great example. Bitcoin ended that year up about 70%, while gold was down 7%. This can just show how in certain economic conditions that Bitcoin can actually prosper more than that of a traditional asset. Over the last decade, Bitcoin was the best performing asset of any kind. Its annualized returns were approximately 230%, whereas gold's annual returns were just about 1.5%. So as a store of value in terms of growth, Bitcoin has left gold in the absolute dust. So let's look at the practical difference here. Gold is heavy, physical, and not very divisible in daily use. You can't email a bar of gold to someone overseas, but you can send Bitcoin with a click. For younger, digitally native investors, Bitcoin is borderless and accessible, value that you can carry on your smartphone or even in your head, such as in a memorized seed phrase. Nigel Green, the CEO of De Beer Group, said it well, and I quote here, "They see it as digital gold, borderless, accessible, and aligned with the future." Gold will always have its place. It's tried and true, but Bitcoin offers gold's key benefits, which are scarcity and trust, in a 21st century form. It's like comparing email to snail mail. Both deliver messages, but one is clearly built for the modern world. So let's take a look at it compared to real estate. Real estate is another classic store of value. This quote, "land is forever," as the saying goes. Homes and properties tend to appreciate over the long run and generate rental income. But how does Bitcoin stack up against housing in the modern year of 2025? So let's look at accessibility and flexibility. Real estate has a huge barrier to entry. You typically need tens of thousands of dollars at minimum for a down payment, loans, paperwork, agents, and just months of time. Bitcoin you can buy with $50 on an app on your smartphone today. You don't need credit checks or lawyers to start. Real estate is also location bound and illiquid. You can't sell your garage quickly at 3 a.m. if you need the cash. Whereas if you look at Bitcoin, it trades 24/7 and is highly liquid. You can sell a fraction of your BTC at any time or take it with you if you move countries. As a Ledn financial blog put it, and I quote, "The real estate market is notoriously hard to invest in. Getting involved in the digital currency market, however, is much easier and open to anyone." So what about the return side? Let's compare some numbers. So over the decade from 2015 to 2025, property prices did rise. An average New York City home went about 52% up in value, and London about 23%. That's not bad at all. In fact, that's quite good. But Bitcoin in the same time, 2015 to 2025, period, it gained over 29,000%. That's the difference between turning $5,000 into maybe $7,500 in real estate in New York versus turning $5,000 into over $1.4 million with Bitcoin. Even shorter term numbers. One study noted that in a recent 5-year span, a down payment on an average property would have yielded only about 80% profit. Whereas putting that money into Bitcoin, it pretty much returned nearly a 40x or 3,112%. It's quite staggering. Of course, not every period will be that extreme, but the point still stands. Bitcoin upside has been in a different league. Moving on though, what about the risks and the maintenance? So you look at real estate, it could be relatively stable, but it's not risk-free. Housing markets can crash, such as in the 2008 financial market, or even stagnate. Certain cities actually saw even significant dips. Manhattan real estate, for example, dropped 31% in one 5-year stretch, leaving some homeowners deep in the red. Plus, owning property comes with taxes, repairs, insurance, and sometimes bad tenants. Bitcoin doesn't leak value through maintenance or property tax. However, Bitcoin can be more volatile month to month. No one is essentially fixing your leaky roof, but Bitcoin's price might swing around. So in essence, Bitcoin is like owning prime digital real estate in a rapidly growing metaverse without the headaches of physical property. It's scarce, there's only 21 million to exist, compared to that of countless acres of land and essentially an infinite supply of what can be houses. Bitcoin's easy to liquidate, and you don't have to worry about hurricanes or broken plumbing. Many of the younger generation under 30 does find this appealing. Owning a home might feel out of reach or too binding. but owning some Bitcoin is very doable and gives you a sense of participating in a new frontier of value. So what about stocks? Let's take a look at another traditional equity here. So stocks are another popular place in the park of wealth. If you buy shares of Apple or an index fund, you own a piece of the corporate world. Stocks can essentially be a great store of value, historically rising as companies and economics grow. But how is Bitcoin different? So let's take a look. What about decentralized versus corporate? If you hold a stock, your fate is essentially tied to how that company performs. Its profits, leadership's decisions, competitions, and of course, even any ongoing narratives. Essentially, if you take a look at this, Enron went to zero. Even giants can stumble. We could take a look at even Facebook when it evolved into Meta, and essentially the stock plunged 70% in 2022. And that was just based on essentially the company and its ongoing future and the changes it was trying to make. But if you look at Bitcoin, it's not a company. There's no CEO who can make a bad acquisition to tank its value, no quarterly earnings report that can miss expectations. Bitcoin is more like a commodity or a currency. Its value comes from its network and usage, not cash flows or corporate strategy. This means it's diversified from individual corporate risks. It's one reason people say Bitcoin is a good addition to a portfolio. It's not directly tied to the fortunes of any single industry or nation. In fact, a lot of people argue Bitcoin competes more with safe haven assets like bonds than it does with stocks. A Bitwise asset management exec actually noted Bitcoin's true competition might end up being US Treasury bonds as a go-to store of value. That's a big statement, but it does also imply that Bitcoin is seen less like a speculative tech stock and more like a fundamental reserve asset. So we saw earlier that Bitcoin was actually the best performing assets of the 2010 by far. And also to enforce this even more, consider this comparison. If you invested $100 in the S&P 500 about 10 years ago, you might have about $300 today, a clean 3 times on your money. $100 in a top tech stock, such as Netflix, would have probably netted you about $4,000 after 10 years, and Microsoft about $1,300. Those are pretty large returns. But again, $100 in Bitcoin 10 years ago would be worth more than $18 million today. So this kind of outperformance, again, I stress, is why investors have reallocated a portion of their stock portfolio into Bitcoin. Even a small slice like this can boost your overall returns. And this is also why I am making this video, is to just truly keep reinforcing this idea of why and how Bitcoin can truly be the number one asset to invest in. So Bitcoin isn't entirely an uncorrelated asset though. At times it has traded like a high-tech growth stock, rising when the markets are optimistic and falling in risk-off panics. But over the long run, its drivers are distinct with adoption, network effects, global monetary trends. Having some Bitcoin along with your traditional stocks can actually improve your portfolio's resilience because its big picture trend, which is digital gold, doesn't depend on, for example, Apple's product sales or real estate cycles. Importantly, Bitcoin's adoption by the financial mainstream in 2024 to 2025 has really solidified its status. Major Wall Street firms launched Bitcoin ETFs, making it easy to invest from a regular brokerage account. These products saw billions in inflows. Over 5.2 billion poured into spot Bitcoin funds in just 1 month of 2025, signaling huge demand from traditional investors. And some public companies literally hold Bitcoin as a treasury reserve. Think of it like a tech company holding gold bars in a vault, but instead of Bitcoin, it's in cold storage. One pioneer, MicroStrategy, now nicknamed Strategy, or rebranded, I should say, amassed over 150,000 BTC by 2025. In May 2025 alone, they just added 27,000 Bitcoin, worth about $2.8 billion worth to their balance sheet. Their stock price trades at a premium because investors crave that Bitcoin exposure. All of this would have sounded crazy a decade ago, but today it underscores Bitcoin isn't seen as some speculative penny stock. It's viewed as digital property or reserve asset. That's a very different vibe from owning a share in one company. So let's continue on though. No discussion about Bitcoin being a store of value is complete without addressing the elephants in the room, which can be the volatility, environmental impact, and the quantum computer scare. So let's take a look at these. So yes, Bitcoin is more volatile than gold or the dollar in short term. We've all seen the headlines of 20% swings in a day. Critics say you can't trust something that can drop so fast. But context is key. Bitcoin is a very young asset. It's just over 15 years old, and it's in a very early growth phase. Higher volatility is the price of rapid adoption. Think about tech stocks such as Amazon or Tesla in their early days. They saw massive wild price swings, yet long-term believers were richly rewarded for riding them out. Over time, as Bitcoin's market cap has grown, its volatility has actually been decreasing. According to the market research, Bitcoin has become less volatile in recent years, with fewer extreme ups and downs as the market matures and liquidity deepens. It's still more volatile than, say, gold, of course, there's no question, but it's stabilizing compared to the 5 or 10 years ago. For long-term store of value thinkers, the trend matters more than the day-to-day noise, and Bitcoin's trend over every 4-year period in its history has been upward. Early adopters even coined the term HODL, which is hold on for dear life, as a semi-joking mantra because those who held through volatility historically came out way ahead. If you zoom out to a multi-year level view, the volatility looks more like explosive growth. One strategy to mitigate the volatility is just simple dollar cost averaging. Many young investors nowadays do this, buying a bit of Bitcoin each week or month, smoothing out their cost basis. This way, short-term dips become opportunities to accumulate. And unlike a house or a bar of gold, you can buy Bitcoin in tiny pieces, which makes this strategy easy. In summary, volatility is real, but it's part of the journey for an asset that has gone from zero to multi-trillion-dollar market cap. As adoption increases, volatility keeps easing. So while Bitcoin isn't as steady as a rock yet, it's proven to be a phenomenal store of value for those with patience and conviction. So another common concern is that Bitcoin mining uses a lot of electricity, sometimes compared to the usage of entire countries. So it is true that Bitcoin mining is energy intensive by design, and that's what makes it secure. However, let's put it into perspective. A 2021 study by Galaxy Digital found that Bitcoin network uses less than half the energy of gold mining industry or the global banking system. Think about that. All the bank data centers, ATMs, branch offices, etc., plus gold extraction and refining, each consume far more energy than Bitcoin does. We just don't see those processes, so no one just tweets angrily about banks wasting energy. But Bitcoin's energy use is transparent and easy to measure, which is what actually sparks healthy discussion about making it greener. And it is getting greener. Bitcoin mining is rapidly shifting to renewable and cleaner sources. When China cracked down on mining in 2021, a lot of it moved to regions with cleaner energy. A recent report in 2025 showed that the share of coal in Bitcoin's energy mix fell from 63% in 2011 to just 20% in 2024, a massive drop, while renewables and other low carbon sources now power well over half of Bitcoin mining. In fact, industry estimates say around 60% of mining energy comes from sustainable sources as of the mid 2010s. The trend is toward carbon neutral mining, with miners incentivized to find the cheapest power. One study noted Bitcoin miners are incentivized to utilize non-rival energy that may otherwise be wasted or underutilized, meaning miners often tap energy that no one else can use, like a remote geothermal vent or excess nighttime wind power. In oil fields, instead of flaring methane, which pollutes without any benefit, companies are now capturing that gas to run Bitcoin mining rigs, thus reducing net emissions. It's a clever solution, turn waste into value. And to cap it off, Bitcoin's total energy consumption is modest on a global scale. Even if Bitcoin grows massively, a study projected its mining would at most use about 0.4% of the world energy by 2030. And remember, about 20 times Bitcoin's current energy use is estimated to be wasted globally every year in things like transmission losses and flaring. So is Bitcoin's energy usage justified? If you believe Bitcoin is securing a new global value network, many argue yes. It's comparable to the energy used by the systems it could complement or replace, and arguably more transparent and increasingly renewable. Plus, unlike gold or banks, Bitcoin's energy consumption can directly drive renewable investment and repurpose the waste energy. At the end of the day, Bitcoin's energy use is significant, but it's not the wanton waste some think. It's the cost of a robust decentralized network. And that cost is increasingly paid with clean power as a young, eco-conscious investor. You can also choose to support mining operations or funds that focus on renewables. The industry hears the criticism and it's evolving fast. So now let's talk about the great quantum threat. So it's always the spooky question of quantum computers. Quantum computing is a new form of super powerful computation that in theory could crack the cryptographic codes underpinning Bitcoin and much of the world's encrypted data for that matter. The concern is that a sufficiently advanced quantum computer could figure out your private key from your public Bitcoin address, basically break the math that keeps Bitcoin secure. Should we be worried about this? In the long term, the crypto community and others does take it seriously, but it's not an imminent threat, and there are plans to mitigate it. Here's the timelines as experts see it. As of 2025, the most advanced quantum computers are still in few thousand qubit range, and to threaten Bitcoin encryption would likely require millions of stable qubits, plus years of development. Many cryptographers and Bitcoin developers estimate we're at least a couple decades away from quantum computers that powerful. Adam Black, a Bitcoin pioneer, stated in 2025 that quantum computers are unlikely to pose a serious threat for at least 20 years. Could there be surprises though? I mean, possibly. Tech can sometimes leap, but there will be many eyes watching if quantum capabilities accelerate. Even the US government and industries are concerned about quantum breaking classical encryption. It's not just a Bitcoin issue, it's an internet and banking security issue. That means a lot of incentive to upgrade cryptography across the board in time. The good news though, Bitcoin can be upgraded too. If a breakthrough was on the horizon, Bitcoin's protocol could implement quantum resistant cryptographic algorithms. There are already candidate algorithms and even quantum resistant blockchains that exist currently. The community will likely move coins from vulnerable addresses to new quantum safe addresses as needed, essentially changing the locks before the burglars get quantum bolt cutters. In fact, forward-looking discussions are already happening in developer circles about quantum proofing. So while headlines might scream quantum will crack Bitcoin, the reality is that it's a challenge that can be met with proactive development. Importantly, if we ever reach a point where quantum computers can break Bitcoin's encryption, they'd also be breaking bank encryption, military codes, and so much of the whole world that it would be scrambling to upgrade its security. It won't just be a Bitcoin problem. We're all in the same boat on that one, and Bitcoin is perhaps better positioned to adapt because of software upgradability by consensus than some traditional legacy systems. So overall, quantum computing is a fascinating topic, but it's not a reason to dismiss Bitcoin as a store of value today. Experts are divided on timelines, but even the cautious estimates give us many years to evolve the Bitcoin defenses. It's like worrying about a Y2K style event that may or may not happen in the future. Prudent to prepare for, but not a reason to avoid Bitcoin for now. When you hear quantum threat, know the community is aware and actively ensuring that Bitcoin will remain unbreakable by the time quantum arrives. Before I wrap up this video, let's bring it home with a few analogies. Think of Bitcoin as the internet's version of gold bars in a vault, except this vault is global, accessible anywhere, and the bars teleport when you need to move them. It's Gold 2.0 for a generation that grew up online, or compares Bitcoin to real estate. Owning Bitcoin is like owning a plot of prime digital land on the internet, except it's finite. You don't have to mow the lawn, and you can sell a tiny piece of it to raise cash without selling the whole property. In the past, when economies got rough or currencies got shaky, people ran to gold or maybe the safety of real estate. In 2025, people fire up their phones and buy Bitcoin. For example, during a recent bout of inflation and bank instability, Bitcoin purchases spiked as folks sought a safe harbor outside the traditional system. The younger generation in particular has confidence in tech solutions. They've seen social media, smartphones, and apps reshape the world in a decade. To them, the idea of a digital currency supplanting gold isn't far-fetched. It feels inevitable. As one report noted, the momentum behind Bitcoin among younger investors is undeniable. This generation is right to question the old models. Consider this real-world story in El Salvador, a country in Central America that made Bitcoin legal tender in 2021. Suddenly, small street vendors and farmers had access to a global monetary network via cell phones. Fast forward to 2025, and other countries have been exploring Bitcoin as an inflation hedge or reserve asset. It's not mainstream for nations yet, but it's no longer unthinkable. On the corporate side, we've mentioned companies putting Bitcoin in treasury. Imagine telling a Fortune 500 CFO in 2015 to hold Bitcoin instead of cash. They think you're absolutely nuts. Now, it's a legit strategy. This is real world adoption, from governments to corporations to everyday people. It's what gives Bitcoin its store of value credibility. It's not just a speculative trading on the fringes, it's becoming woven into the global financial fabric. So let's answer this big question. Why is Bitcoin the best store of value in 2025? Because it combines the best qualities of traditional stores of value with the power of modern technology. It's scarce like gold, but more portable and divisible. It can offer growth far beyond real estate or stocks, as we've seen over the past decade. Yet it's not tied to the fate of any single economy or company. It has survived and thrived through multiple boom-bust cycles, each time coming out stronger, a sign of resilience. And perhaps most importantly, it resonates with the values and needs of the younger generation. Open, global, digital, and independent of old guard's control. Sure, there are challenges and debates. Volatility will always be something to manage. We must continue pushing for green mining and smart regulation, and eventually upgrade tech for quantum resistance. But none of these are deal breakers. In fact, BTC has a history of overcoming obstacles. It's like a living organism that adapts through its community and code to whatever is thrown at it. Whether it was the Mt. Gox exchange collapse in 2014, the 2021 China mining ban, or regulatory crackdowns. Each time, Bitcoin didn't die. It got stronger and more widely adopted. By 2025, it's clear that Bitcoin is not a fad. It's here to stay, and it's earning its place in portfolios big and small as a reliable store of value. For those under 30, many of whom came of an age during the 2008 financial crisis or the pandemic money, the printing era, Bitcoin represents a kind of financial freedom and optimism. It's a bet on a future where value can be transferred as easily as information, where your savings aren't at the whim of central bank policies, and where anyone in the world can opt into a fair, open monetary network. That's powerful. It's why we see such a passion in the Bitcoin community and why terms like HODL or stacking sats have become a part of pop culture for millennials and Gen Z investors. So is Bitcoin the best store of value in 2025? Many would say yes, and with good reason. It has the macro trends like unsustainable government debts and inflation fears fueling demand, the micro fundamentals having driven scarcity, robust security, growing user base, bolstering its value, and a track record that outshines virtually every alternative over the last 10 years. It's bridging the old and new, Gold 2.0 for a digital world. If you're new to this, it's normal to be skeptical, healthy even. But hopefully, this deep dive has shown why so many people have become believers. And this saying goes, don't trust, verify. Look at the data, the history, and the direction things are moving. Bitcoin has proven itself as a formidable store of value, and it's never been more relevant than it is in 2025. Whether you decide to invest or not, the rise of Bitcoin is teaching us all a lesson about innovation and the evolution of money in real time. Thank you for watching and learning. If you found this informative, just please give it a like and share with a friend who still thinks Bitcoin is just video game money. And as always, stay curious and stay informed. The financial landscape is changing fast, and Bitcoin is a big part of that story. Happy hodling, and here is to the future of value.